All right, so I want to invest in this company, and I am trying to look at the balance sheet and looking at the company's financial statements, but I have no idea what all these numbers are and what I'm even looking at. Is this you? Because this was me just a few years ago. But lucky for you, you now have me to explain. I'm Kalila Reynolds, and it's time for another episode of Money Mondays JA.
Money Mondays JA is brought to you by Proven Wealth. Visit provenwealth.com to speak to an investment advisor today and follow We Are Proven on social media.
Now before we get started, don't forget to like this video, subscribe to this channel, and of course, subscribe to my newsletter at KalilaReynolds.com/newsletter. Also check out the main site where you can read a full transcript of this episode. Well, the financial statements of a company capture its overall performance, how and what it uses money for, and what the business owns and owes. There are three financial statements that bankers, investors, shareholders, and other interested parties, including you, need to look at when you want to get information. So these are the profit and loss statement, you have the balance sheet, and you have the cash flow statement. A business financial year is 12 months, and that can start at any time within the year. However, a company's financial year must be fixed to allow for easy comparison of financial statements over different years. And what I mean by this is that if the financial year starts in July this year, then it should also start July next year and the following year. You can't start July this year, then September next year and just be all over the place, because that will make it really hard to compare performance year over year. Now, financial statements came about as currencies developed. Many business owners would hire a bookkeeper to record business transactions. As more companies formed and their need for capital to invest in businesses grew, businesses started publishing their financial statements in order to attract new investors and provide information to their current investors. This led to the accounting profession. Shareholders eventually asked somebody outside of the company to review the financial statements just to ensure that they're accurate. And this is when specialized accountants known as auditors came in. All right, enough of the history lesson, because there's a lot to cover. In this episode, we will be only looking at the balance sheet. So a balance sheet is a statement that sets out a company's assets, liabilities, and capital. An asset is a resource that a company owns with the hopes that it will help the company to make some money now or in the future. The balance sheet is divided into three sections: assets, capital, and liabilities. The listing of the company's assets is usually in the first half of the balance sheet. A company's assets are divided into categories. The three main ones are intangible assets, fixed or long-term assets, and current or short-term assets. Intangible assets, as the name suggests, are resources that you cannot see or touch. These include things such as trademarks, copyrights, and goodwill. Goodwill is the value the company's customers place on the company. While some companies include intangible assets on their balance sheet, one such being Seprod Limited, many choose not to because it can be difficult to calculate a value for intangible assets. Let's look at Lasco Manufacturing, for example, using goodwill. Now, the company's balance sheet may say that the company has assets valued at 1 billion Jamaican dollars, but to us, Lasco has so much more value because of the memories we've attached to using Lasco products. Some of us have been using Lasco powder since we were babies and still use it today to make drink mixes or cereal, and we'd be devastated if Lasco was to stop producing Lasco powder. That is Lasco's goodwill. But how much is that actually worth in dollars? See, that's where it gets tricky. Now, the next category of assets is fixed assets. Fixed assets usually include plants, equipment, buildings, and motor vehicles. They're called fixed assets because they usually serve the companies for a long time and they're fixed. They're not easy to move. At the end of each financial year, accountants calculate the value of the assets, taking into consider wear and tear, and then report the value on the balance sheets. Current or short-term assets are assets that, as the name suggests, do not last long. These include inventory, receivables, investments, and cash. Inventory can be further broken down into finished goods, work in progress, or raw materials. The inventory amount that is reported on the balance sheet is the inventory that remains on the last day of the company's financial year. Receivables is the money that the company is yet to collect from its clients for goods or services that have been supplied to them. Investments include things such as stocks, bonds, and fixed deposits. And lastly, cash is simply the amount of money that they physically store at the business and keep in their bank accounts. Now, the first half of the balance sheet is set out like this because the assets are usually listed according to their liquidity. Liquidity means how fast these assets can be converted into cash. The assets that take the longest to be sold, such as property and equipment, are listed first. The most liquid asset, cash, is listed last. In that case, property, plant, and equipment are listed first because they may take many years to sell. Then motor vehicles, which take a couple months. Then come current assets. Inventory may be able to be sold within weeks. Receivables may take some time to collect, but not a whole long time. Investments can be sold off within a couple days to get cash. And lastly, of course, there is cash. Cash is the most liquid. Companies can just take the cash they have and use it to pay their creditors or employees instantly. Fun fact, the balance sheet can be represented as an equation. Wait, come back. I know you heard equation and you were about to run away, but this is a very, very simple equation, right? A balance sheet is presented so that assets equals capital plus liabilities. A equals C plus L. So basically, the company owns assets, but it has to use money to purchase those assets, right? Well, these assets are purchased using capital from shareholders and loans. That's it. Assets equals capital plus liabilities. See, very simple. So we've already looked at the asset side. Now we'll move on to the second half of the balance sheet that contains capital and liabilities. Capital consists of a number of items. The simplest definition is that it is the money invested by the owners of the business. This is the same thing we call equity. A company's equity is the same thing as its capital. However, oftentimes when we see equity on a company's balance sheet, there are other things that make up equity. These may include reserves and/or retained profit. Reserves are really just profits from previous years that the company has saved or stored away for future use. Retained profits is the sum of net profits from previous years that the company keeps back instead of distributing to shareholders. This retained profit is reinvested into the company to add more assets for future growth. When all these items are calculated, the total is called shareholders' equity. So just so we're clear, capital is the money invested by shareholders or the portion of retained earnings held back by the company to reinvest into the company and grow. Now, next up is the liabilities section of the balance sheet. Liabilities refer to all the money that the company owes to its creditors, including suppliers and banks. Remember, assets equal capital plus what? Liabilities. Now, because the capital may not be enough to buy all the assets that the company needs, the company must then look to get money from other sources. A company increases its liabilities when it takes goods from suppliers with the intention of paying later as credit, credit me, trust me, or when it goes to banks to get a loan that is to be repaid over a number of years. Liabilities that are to be paid back within the year are known as short-term liabilities, while liabilities that are to be paid back over a number of years are known as long-term liabilities. Now, sometimes when we look at the liabilities section of the balance sheet, we may see line items such as tax payable or post-employment benefits. Tax payable is explainable. It's money that the company owes to the tax office, while post-employment benefit is pension that the company collects from the employees and that they will have to pay back when the employees retire. Now we understand what each line item on a company's balance sheet means. When we look at the audited balance sheet of a company, there are some numbers that are placed beside these line items. Do you know what they mean? Well, the numbers are a sort of key to guide you to the notes of the financial statements that accompany audited financial statements. The notes provide further details about that particular line item and help to provide answers to questions we may have as we review the balance sheet. For example, the number 15 beside inventory on Alaska Manufacturing's balance sheet takes us to Note 15. Note 15 tells us the total value of raw materials, finished goods, and goods in transit. Now here on Seprod's 2020 audited balance sheet, the number 28 beside long-term liabilities takes us to Note 28. This note provides a detailed list of Seprod's outstanding long-term liabilities. We can get information on the number of years the loan was given for, the interest rate, and the collateral that was used to secure the loan if the loan is secured. Now, while it's good to look at a company's balance sheet, looking at only 1 year's balance sheet will not provide a lot of information. With the balance sheet for 1 year, we may be able to write a small paragraph. But if we look at the balance sheet for, say, the last 5 years, we may be able to write a whole book about the company because now we have a story. When investors look at companies, they use ratios to assess how the company is performing. So we can compare the current assets to the current liabilities to see if the company is able to cover its short-term liabilities. This is called the current ratio. We can compare total debts to total assets, and we can also compare total debt to total shareholders' equity to see how much of the company's assets were purchased on credit. The finance people call these comparisons leverage ratios, and they're used to determine how much of a company's assets are purchased using debt. Too much debt is not good because if a company is to go out of business, then the assets will have to be sold and the proceeds used to repay debt, and the shareholders end up with no money to just sell. Well, as we mentioned before, if we look at the leverage ratios for 1 year, we don't get much information. However, if we compare ratios for 5 years, we can tell if the company is taking on more and more debt, or if debt level remains the same, or maybe the company has less debt. Now, one last thing to consider when you're looking at the company's balance sheet and using leverage ratios. In addition to comparing ratios over several years, you also might want to take a look at the leverage ratios of other companies in the same sector as the one that you're analyzing. So if we're looking at Alaska Manufacturing, we may have to look at Seprod, Honeybun, Grace Kennedy, and Wysinco to truly assess the company's performance. And why, you may wonder? Well, because you may look at the leverage ratio and think it's too high. However, manufacturing companies require a lot of assets. So most companies, if not all companies in the manufacturing industry, may have high leverage ratios, whereas companies that provide services may have lower leverage ratios. So understanding how to read the balance sheet is important. However, it is through comparing balance sheets for several years and the balance sheets of similar companies that we're able to assess a company to determine if it's worth investing in. Makes sense, right? So we need to see a history of performance. In another episode, we look at profit and loss statements. So how do you identify companies that you want to invest in? Do you look at the company's balance sheet? Let me know in the comments. That's it for this episode of Money Mondays JA. Now here's what's coming up on Taking Stock. On this episode of Taking Stock, should you invest in Cygnus Real Estate Finance's IPO? Shares for the public cost $19.30 Jamaican, or a little less than 13 cents US. They want to raise nearly 4 billion Jamaican dollars. The SRF team will tell us more.
We have two joint lead brokers, Surgical Investments and Scotia Investments. You can speak to any one of their representatives. We have 5 selling agents on the transaction, and pretty much, the subscription is going to be run through Surgical's e-invest platform.
And the analysts weigh in on the latest market developments. They'll give us their take on SRF.
And the fact that they're going to be focusing more on the value stage of real estate financing is extremely lucrative, because that's when you're able to extract high returns for your shareholders. So it's a very good strategy.
We're also looking at Supreme Ventures earnings report. Now that Easy has entered the market, how has competition affected SVL's performance?
It's kind of mixed in the sense that you've seen stronger revenue, but the operating profit kind of coming in a bit, and that could be due to competitive pressure.
And the Delta variant of COVID-19 is wreaking havoc on the US market.
Earlier this week, on Monday, the Nasdaq had its worst day for 2021. And I think it was on like 1 or 2%. And that was just, based on the increased fears of Delta pushing us back into further lockdowns.
Don't forget to like this video, subscribe to my YouTube channel, and sign up for my newsletter at KalilaReynolds.com/newsletter, where you can read a full transcript of this episode. You can click the link in the description box below. Also follow me on Twitter and Instagram at Kalila Ray, and on Facebook at Kalila Reynolds Media. If you're into podcasts, find us on your favorite podcasting platform, including Apple Podcasts and Spotify. We're also on Amazon Music and a whole bunch more. I'm Kalila Reynolds. Let's get this money.
Money Mondays JA was brought to you by Proven Wealth. Visit provenwealth.com to speak to an investment advisor today, and follow We Are Proven on social media.